Hi guys, this is Lee with the Market Sense for the week of October 1st, 2019. Charts in this presentation are provided to us by Gettess and come from their Trade Navigator software. And this is the bond market, the weekly 30-year bonds. I'm a little concerned about this market, and I'll try to explain why here. After this exhaustion bar down, we got a good recovery here and a little more next week, and now they've started sort of screwing around a little bit, and they appear to be holding this resistance here, which is, I'm going to give this an area from 163.05 to about 163.17. We'll call that the resistance here. They seem to be holding that. Now, they also seem to be holding support here, 160.24. So why am I negative? Well, this momentum indicator down here at the bottom of the screen looks pretty negative. The move back up has not turned this RSI up hardly at all, and certainly not above its moving average. So the danger is that this is a turning point to send them right down through the lows, or at least back down to the mid-Keltner and testing those lows. It's not really a prediction. Like I say, it's a risk. And of course, if they were to turn higher and start trading above 164 here, this indicator might change and go positive. It might turn up above the RSI moving average at that point. So the thing is, we've got a unemployment report due Friday that's probably going to jolt the market to some degree, and that could turn them up or down. There's no telling what's in the report. So whatever they do before then may not be what they're still doing come Friday afternoon, and that always makes this week, the first Friday of the month, a real difficult one to trade. But that's my concern at this point. They look good. They've recovered from this exhaustion low, and they're looking okay, but holding this resistance here concerns me. If they don't get above that fairly quickly within the next couple days, then I think the risk is that they want to go back lower. And stocks have a similar situation, although maybe not quite as dastardly. I guess that's an opinion. They, after making this high here, they had this little inside bar, which they appeared to break down from last week, but nothing significant. They did close below it. They just didn't plummet. Well, now this week, they've opened back and went back up to the mid-moving average here. It's around 29.91. And they've turned down. Tuesday was actually quite an ugly day, looking very, very weak. Now, they're at a rather critical area here, and let me say, at this point, they really haven't done any damage. I mean, they held low resistance, and they've taken out last week's low, so none of this is good. But they haven't really done any damage, and it's possible that they can, stay above this mid-Keltner channel here, which is about 29.32, 33 roughly. And if they do that, then, I guess they're okay. They're sideways at worst. But I think they could break lower. I think 28.80, which is sort of like an imaginary line right in here, I think that's a likely target, and I'm not sure but what they could turn down and take out these lows. Now, granted, the impeachment discussion could have something to do with that, but I think Friday's employment report and maybe what various Fed governors say leading up to it might have more of an impact than anything else. I just see both markets as having the potential to turn fairly negative here. Doesn't mean they will. I just see the potential, so I'm a little more concerned than normal, because I'm a pretty positive guy usually. So that's what we've got for you today. I hope you can find something profitable to get yourself